Hello, welcome to the July 19 weekly market chat. Welcome you guys. And today, me, Johnny, and Dave, and also we have a special guest here. We have Barry, and together we are going to discuss market overview. We have some interesting topic like the heated topic of Ethereum 2.0 merge, and we'll talk about the expectation and also development of the price action of Bitcoin and also Ethereum. And then after that, we're going to do some technical analysis on Bitcoin chart and also Ethereum chart. So make sure you stay tuned. And in the third part, we are going to talk about some accumulative pattern of Wyckoff we identified in Bitcoin, also Ethereum chart. And lastly, Dave will talk about the Ethereum 2.0 pump and also other associated valuable protocols like Lido, OP, and also near and other variable protocols which deserve your attention. So let's look at today's top 10 coins. Bitcoin is now standing at 22K. Pool market cap is 400 million, and then 400 billion. And now we have Ethereum standing at 1,500. And the top 10 coins are here. And then let's look at the Bitcoin chart. And right now we are standing at 22K, and we are going to push towards the resistance lines that we can see here to the top range of this trending line. And it's very important to note that if we can push through this resistance line, we're probably going to see some uptrend development, just like what ETH did in the past few days. It exploded to from 1,200 to now 1,500, and it keeps pushing for it. It's very exciting. We are welcoming some very new gains into the crypto market. We have been waiting for a long time after seeing the losses and also some pathetic events. Liquidity crisis happened in the crypto space. So yesterday Jim Cramer rang the bell since 15-year celebration of Mad Money in New York Stock Exchange. And last time Jim Cramer rang the bell in 2020, the S&P 500 dropped 2%, and after that, the COVID crash happened. And yesterday Jim Cramer rang the bell, and we are going to see yesterday Jim Cramer ran the bell here, and then the stock market, we traced a little bit, and hopefully today it's going to perform better than yesterday. And as we look at the Ethereum chart, it keeps pushing higher, and we're very excited to see the long-awaited price action. This bullish trend is very exciting. And it's definitely, we have the news that Ethereum 2.0 is going to merge in late August and September. And Barry will talk about the Ethereum merge. About I will have some questions about the Ethereum merge and expectation. Maybe Barry, can you join the conversation? Like, maybe we can talk about what actually is the Ethereum 2.0 merge. Hello, Barry.
Yeah, I'm here.
Yeah,
Oh, uh, my turn.
yeah, we can hear you.
Okay. I will talk about what is merge and something about merge. Can I start?
Here, and hopefully we're going to solve it. Hello, Barry.
Yeah.
Yeah, let's start. Let's start talking about Ethereum 2.0 merge. What is
Oh,
Ethereum 2.0 merge, Barry?
I will start. First, I will talk what is a merge. Two networks are live in the current Ethereum. One is our old friend Ethereum network, which is powered by POW, proof of work. The other is Beacon chain, also called ETH 2.0 earlier, which is enforced by POS. Beacon chain has maintained its stature after launch, with a steady increase in ETH stake in smart contracts up to the current 13 million. The merge stands for the merger of Ethereum blockchain and Beacon chain. It is not a simple math of combination. Instead, it is an integration and upgrade of the two, trimming the unwanted from the two that may undermine the long-run development of Ethereum, while preserving and combining the desirable parts. That said, POW will be isolated from Ethereum mainnet while retaining and transporting the function of smart contract execution, full historical data, and current user status to Beacon chain, powered by POS. It is not merely a normal upgrade of forking, but a major change in the consensus mechanism. POS verifiers will replace POW miners during the merge. When it happens, Beacon chain nodes will monitor the current POW chain and measure a predetermined difficulty threshold value, which is called terminal total difficulty. Any block with a difficulty level over the threshold will be marked as the final POW block. From then on, blocks generated and verified by verifiers on Beacon chain will all be POS blocks, signaling the completion of the merge. If any technical issues occurs during the process, the network may become unavailable briefly. However, assets will remain safe no matter where they are stored. No consensus is present on the network. Thus, no theft can take place. Exchanges may disable deposits and withdrawals during the merge. So users who are concerned with potential forced liquidation due to price volatility during the process may wish to make a deposit in advance. In comparison with the merge, the previous plan has intended to support 64 sharded chains on Beacon chain with independent POW Ethereum operations for another 3 or 5 years, where users can migrate at free will. Therefore, no such merge even exists. However, the merge adopts the Ethereum mainnet without POW as the first sharded chain of Beacon chain and integrates the two thereafter. Meanwhile, users and applications are merged to the POS Ethereum network. The merge now stands as the most viable route, as the previous plan's technical route with various sharded chains was associated with the unprecedented challenges of developing sharded chain in the short term. Conversely, the merge could inherit the previous execution layer, which requires less effort. At the same time, there will be minimal impact on users in terms of discernible chains. Their transition costs are minimal. Or it's all.
Yeah, thank you, Barry. I think you gave a lot of, informative things that we learned about the Ethereum 2.0 merge, and probably we are seeing a lot of excitement in the space. And what Ethereum users need to do with the merge? Do they have to stake in Lido, or do they need to participate to, to join the Ethereum merge? What can Ethereum users do right now?
Oh yeah. Uh, I will answer you. By the nature design of the development team, the merge provides a seamless transition to POS for clients who will become the execution layer. For end users and developers, the execution layer is where most interaction with Ethereum take place, and most functions, for instance, EVM, state, and execution method, and so on, and APIs will not change as a result of the merge. As someone said, the merge may be completed after one takes snap, and no one could even notice. So users don't need to do anything. They just sleep and enjoy the search, enjoy the merge. That's all.
Yeah, thank you, Barry. What about will Ethereum turns into a deflationary asset after the merge?
Uh, it's a good question. Many holders maybe want to talk about it. The merge will move Ethereum from POW to POS, stopping the production of new blocks under the current POW. This puts an end to traditional mining rewards, as any incremental ETH in the system can only be minted by participating in the POS verification process as nodes. This will greatly reduce the total supply of ETH. The issuance of ETH is expected to plummet when Ethereum moves to POS. Further, even when the merge is completed, the system will not release any locked ETH in staking. By design, the first unlock of ETH will be granted after the first hard fork when the merge is completed, which will be months later. Meanwhile, the system imposes a strict quota on the daily amount to unlock and the total number of applicants to prevent large-scale dumping. While the supply of ETH is cut, its net burning rate or destruction rate is increasing. According to the current data, the supply of ETH will grow to around 600,000, but due to the launch of EIP 1559, around 1 million and possibly more will be burnt when the market is not hot. From the two perspectives above, ETH will see deflation eventually, even without the demand from POS staking and protocols in the ecosystem. Since the rule of supply reduction is analogous to the rule of Bitcoin halving. The community named it triple halving. Bitcoin needs 3 halving to reach the supply reduction effect of ETH by the merge. From historical data, Bitcoin halving is closely tied to the crypto market life cycle. When the new supply of Bitcoin halved, it remains liquidity on the secondary market was drained slowly, cause its price to rise and create a bull market. Similarly, as a cryptocurrency with the second largest market cap, ETH deflation may boost the market like what Bitcoin did. It's all.
Thank you, Barry. A lot of us are worried that will there be a hard fork in the coming future about Ethereum?
Hard fork.
Yeah.
Recall that the current Ethereum is a product of hard fork. Will history repeat itself with this large-scale upgrade similar to the hard fork event of ETC? Based on current facts, Ethereum follows a scientific technical route and its legendary vision, which will greatly improve its performance and draw sufficient participation from more sustainable future development. On the other hand, the difficulty bomb would force POW miners to retreat from their original battlefield of Ethereum mainnet. The community adheres to the merge at a high level, so not a single strong voice for fork is heard from any joint miner groups. Assuming that miners could simulate a new analogous network to Ethereum. For example, we name it ETH Legacy, which is identical to POW Ethereum, but without the difficulty bomb. The new network would face several strong competitors long before the launch. These include Ethereum itself and other Layer 1 chains. And this challenge is additional to the issue of insufficient assets. After forking, ETH has to duplicate the whole ledger of Ethereum. Not only will the forked tokens emerge, for example, I name it ETL. Derivatives from other assets must also be dealt with, such as WBTC, USDC, DAI, Link, BUIC, CryptoPunks, and others. No matter where the assets were issued, whether the issuing institutions are centralized or decentralized, only the uniqueness of the assets matters as only assets. The one network will be recognized. To be more specific, only assets on POS Ethereum would be recognized by the issuing institutions as bona fide assets. It means real assets. Obviously, ETH Legacy or other similar entities are more likely to have an early demise due to poor performance, insufficient assets, and weak consensus. So a hard fork is less likely to take place after the merge. That's all.
Thank you, Barry. Thank you for the information and also knowledge about the Ethereum merge and the coming future development of it. Right now, I think we are more interested and worried about the development of Bitcoin prices and ETH prices as they push higher, keep pushing higher. If we Let's move on to some technical analysis of Bitcoin and also Ethereum. Bitcoin right now is standing at 22K, around 22,178. And right now we are seeing that it's actually moving from the lower trend line to the upper trend line. It's pushing higher. It keep pushes higher. And then what we are seeing here is actually a Wyckoff accumulation event. If we look at here, I want to show you guys the events that happened in the accumulation phases. When Bitcoin dropped from last time we were standing at 30, 33K, and then we had a rapid drop to 70K. And then right there we had a selling climax in which demand stepped in. We can see that the trend reversed, and the reversal actually set up the automatic rally, which defined trading range for the accumulation phase. And then after the accumulation rally, we have a secondary test to test the supply of the market. And then it pushes up to the secondary test of the upper boundary, to the yellow line. And then after that, we test on the lower boundary again. It's basically caused by some short covering and also buybacks, so that we can see a spike of volume around 18K there. And then after that, the demand stepped in again, and we pushed to the upthrust of the upper trend line, and it's actually the phrase B of Wyckoff accumulation event. And after that, we are going to see we saw actually a downtrend to test the lower boundary again. And on that day, 13th of July, when the CPI released, it's actually a shakeout, as we can see closely. If we look closer into the chart, the spring is actually the terminal shakeout. What it did is actually it flushed out the remaining supply from the market, and so that people who long Bitcoin can acquire more liquidity at a low price. And then it pushed higher to the upper trend line now with some growing volume, as we can see there. And now it's probably at the last point of support. And whether this scheme will be successful or not, actually is not predictable. We can only see the price development of current prices, and we know the probability that this scheme is going to play out will be greater if it respects the scheme of Wyckoff. And if we look at Ethereum, it's actually pulling a similar scheme. It actually follows Bitcoin. It dropped from 21K, and then down to 878 probably due to some liquidity crisis, and we saw a lot of liquidations across the space. And then it's actually the selling climax at the bottom. We had a spike of volume, and also after it dropped to 800, and then we had trend reversal, very rapid. The demand stepped in, consumed the supply, and then it pushed upwards. And we have the automatic rally here. It's actually the phrase A of Wyckoff accumulation event. And then after that, it actually set the trend line for the accumulation trading range. The trading range is around 1,000 to 1,200. Within this range, smart money or big liquidity are going to test the market demand and supply, and to determine if this scheme is going to play out, and if they can acquire as much liquidity from the market, and also if they can absorb the supply from the market from doing these kinds of testing. After the automatic rally, we have the secondary test to the upper boundary, and also after the secondary test to the upper boundary, and then we pushed lower to the secondary test of the lower boundary. And then we can see that the secondary test here, compared to selling climax in previous events, actually had a reduced volume, which means that sellers were becoming weaker. There were less sellers in the market than the previous selling event, and that's actually a relatively bullish case in this scenario. And then we pushed upwards to the upper boundary again from 1,200 to that area, and then some loans are going to take profits and probably pushed back to the lower boundary to 1,000, and then we had final shakeout in which we could see a spike of volume on that day. CPI released, and the expectation, the CPI data was higher than our expectation, and then it's actually bearish to the crypto market. However, we were seeing some different reaction of the market. It actually pushed up higher after the dump. The reason for this is very interesting. Maybe we can ask Dave about the reason behind the CPI dump and pump event. Why is this like that? What we originally we supposed that we had a lot of selling pressure, and then the market is going to to go lower. But the demand stepped in and consumed the supply, and that's very interesting because the CPI data supposedly should be a bearish indicator of the crypto market and also for stock market. But the outcome was that it's not actually not that bearish at all. Dave, would you like to talk about the reason why CPI on that day we had a lot of demand stepping in? Was that because of the Ethereum merge, or maybe it's and maybe it's actually not a bearish factor for the crypto market? What do you think about it, Dave?
Yeah, I think like CPI is actually a catalyst. Is a good thing, Like if we have the expectation of the bearish market, due to the CPI increasing CPI, and that is going to lead to rate hikes by the Federal Reserve. But actually, right on that day, July, like 13, that before the CPI was released, like 18 hours ago, we are doing longs a lot of altcoins, like eight, like GMT, like Looks Rare, like Manic, like Optimism stuff. Why is that? So it's like, of course, why these altcoins are doing, a great moves? It's because the market is expecting, a movement of downtrend. So the retail are expecting a downtrend, a sharp fall, a pitfall of the market. But the hedge funds know that CPI is not going to be as bad as it seems, right in July to June, this period. So right now, what we saw on the CPI was like a June to May, period. So of course, if we look at the commodity prices, like gold, like soybeans, like corn, like US oil, like WTI crude oil, if you type it on JMail, it's all at all-time high from May to June. But after, June, it's all picking up, it fell from all-time high, most of the commodities, So what I think is like, before the CPI, release, the hedge funds are pumping up the market to test if retails are really buying up or buying down. If there is no liquidity from the retails, the hedge funds know that there is no liquidity from the retails that is going to share their profit for the pump. So after CPI pumps, of course, the market just dump on the retails or just dump on the CPI release because it seems like the CPI is a very bearish market, very, very bearish, signal. But actually, if we know CPI has peaked, has reached all-time high, so and later months like August, September, like October, the market is going to price in the CPI that it's going to go down. So after CPI down, it's pumped. So remember that I shorted RA and do the sales short squeeze and pump up all the altcoins and stuff. So what I think is like no investment advice though, but we should be aware of what market is expecting, what retailers are expecting, and what the whales are doing on the market. What do you think, Johnny?
Yeah, I think you mentioned upon that the expectation of the market. We had a difference here between between retail expectation and also smart money expectation. Actually, smart money saw the CPI data as a bullish indicator because it's actually lagging, and they expect that inflation has already been curbed, right? We already saw prices of commodities going down, and supposedly this CPI is lagged, and it really didn't have a strong signal of revealing a hiking inflation rate, and that's why they saw an opportunity and they grabbed the opportunity and they took the liquidity from the retail dumping on that day, which really gave them some very attractive and lucrative and also profitable entry prices. And that's what we observed from the market right now. And yeah, so back to Bitcoin. I think it's actually trending upward, right, Dave? And it's standing at 22K. And right now, we could see that yesterday it tried to break the trend line, and if it broke the trend line, we would already saw a rally upwards. But however, it failed. We saw some supply stepping in, as we can see. The volume increasing when price going down, and there were some supply, absolutely some supply there. And right now we are expecting the price to move upwards as it's already pumping, right? And if we look at SPX, oh, that's a very good opening, right, Dave? What do you think about the SPX?
Wow, dude, this is what we are expecting,
Yeah, this is what I expected.
Remember.
It's very juicy
Yeah,
here.
it's very juicy, bro. It's like what we're expecting in the afternoon.
Yeah,
SPX is also having a Wyckoff accumulation together with
yeah,
Bitcoin accumulation together with Ethereum accumulation, with
yeah,
all
definitely.
coins accumulation with breakout VCP,
Yeah.
volatility contraction down from Mark Minervini. All things are going to contract, have the pounds to pump up. This is what we are expecting. So, what do you think, John?
Yeah, this pump actually signal a bullish development of the stock market and also the crypto market, and probably we are going to see. I just drew a trend line from the top. Yeah, this trend line, and if we are able to break this trend line, we are going to see some bullish development very soon. That's the only case if we break the trend line, and we're gonna stay tuned to the market. And right now, Ethereum keep pushing upwards, and we are so focused on whether if the Wyckoff accumulation can be played out. The scheme is very important. It's right now pushing up to the sign of strength phase. It's actually breaking the resistance, and if we successfully break the trend line, we're going to see some short covering, some short being liquidated, and also we have some many long entries because the trend is broken, and we expect more bullish development, and that's a great bullish development, and we're going to see maybe a minor bull cycle. We don't know. We don't know how far this cycle. We don't know how far this cycle can go. But we know that if this Wyckoff accumulation, if this Wyckoff accumulation scheme played out, and then this would be the bottom. This would be the bottom for Bitcoin in relative term, right? At least around this periods, like this months, by the end of 2022, I think this would be the lower bottom, as indicated by some other indicators like realized price. Is the Bitcoin price is actually right now climbing up the realized price, and also it is getting previous during the selling climax, the price at 18K is really close to the CBDT indicator, developed by Willy Woo, which suggests that the base price for Bitcoin is around 15K, and demand stepped in around 18K, rejected the selling pressure, and now we have more demand than supply in the market, as shown by the chart here. The pullbacks are some excellent points for entry, not financial advice though, just some technical analysis. And we are definitely going to see some bullish development since the stock market opened high, and it's going to trend. If it's going to trend upward and break the resistance line, that would be great. There would be some juicy development here. Going to take some profits here. So after some technical analysis, and also we talked about the Wyckoff accumulation scheme, and then maybe we can, if the Wyckoff scheme played out, the Bitcoin Wyckoff scheme played out just like what Ethereum did, and then we are expecting to see a a bull cycle coming ahead. We don't know how far this bull cycle can go, but we definitely know that in the future, in the coming weeks, we are going to see some upward price development, some uptrend development coming ahead. And we want to talk about some valuable protocols associated with this bullish trend. We actually have some gem picks for you guys, so let's stay tuned to it. And Dave, maybe we can start talking about some gems that we discovered in the market. Some protocols actually survived from the crypto winter, from the bear market of last cycle, and they proved that they had value. And now we are going to we are going to realize that actually these are some the valuable protocols, and maybe we can talk about it right now, Dave.
Yeah, wow, awesome. It's like we're doing gem hunting, That's a really juicy word for crypto, the gems are crypto native. So back to the before speaking about gems, so we'll start, talk about like why we expect the markets to go uptrend instead of downtrend, just what was that, like the CPI stuff. So I think as a average or the professional investor, no investment advice though, just just to say, So when we look at the CPI, whether we are expecting CPI to go up or go down, we have to see the actual ingredients and actual content of the CPI, and also all the inflation stuff that triggers the fear and depression or disbelief on the market. So if we look at the chart on the table on the left hand corner, so we can see there are a lot of agricultural stuff like sugar, coffee, orange juice, corn, soybean oil, a lot of stuff like gas, oil, gasoline, crude oil. They're all going to, like a downtrend, So are these commodities? Yes. Do they contribute to the CPI hike? Yes. So if we look at the ingredients that after the last CPI release, they're all going downtrend. So why do we not expect CPI to go, down? So as this is also a trading strategy or investor strategy. It's like back to similar to like Mike Burry. So why he found out that it's a good time to buy the credit default swap of the 2008 the housing subprime mortgage debt crisis, and he is actually doing quantitative analysis of the leverage level, and also to check on whether they are like the leverage level, the overall leverage portfolio of each or overall like house owners. So they think Mike Burry actually thinks that the housing crisis is going to blow off by over leveraged house owners. So if we do the fact checks, we are going to know that it's actually having a downtrend on the CPI. Just guess though, anything can happen in the future, but I think that like right on the chart, yes, oil still all going downtrend. If we go to look at the next one, so WTI crude oil, copper, soybean, corn, these are the commodities that you can actually do checks on trading well. So even you have a free account or the Black Friday sales, a magic stuff, account. So you can also check on the WTI crude oil, soybean, corn, silver, and USD, SOYB, USD, copper, WTI crude oil. These are all going downtrend, So also we can look at the correlation with the general market. So if we on the next one, if we look at the S&P 500 and CFD, and also the Dow Jones 30, the US 30, ticket, you can see that we're actually approaching to the C wave or the ETH wave that is hitting 382. That level is going to symbolize that the C wave is going to hit the peak. or the bottom. The bottom is like C wave is a downtrend, so the end of the downtrend is a C wave. So the bottom is going to be indicated, and what we saw on chart is actually quite impressive that it's going to play out the yield wave scheme. And on the next one, that we also have to look at it in Nasdaq and also our previous string index. That in our previous string index, we actually know that the strings are trend upwards. And so as either the strings are selling the pain level or depression level, or there is no one doing the transactions. In either cases, it really benefits the wealth from accumulating with the Wyckoff, approaching with the Chinese Wyckoff accumulation charts, so or similar or collaborative. So on the next one is like back to the gem hunting. I think our audience will really be interested on what kind of gems are going to be great if they going to pump the price, they're going to enjoy the ride and stuff. But no investment advice though. So we're back to gems. What are gems? Gems is like the gold or the good investment products that you invested, and it's going to go like a rocket to the moon. So if you look at this table is symbolizing the project like Uniswap, DYDX, PancakeSwap, Curve, Sushi, Doodle, Blueprint, 1inch, a lot of stuff, and why are these valuable? Because like after the bear phase, after all the whales are liquidated, institutional capitulations, and a lot of stuff are being liquidated, we can always see that there are some good protocols and valuable tokens that survive, and they actually generate good values and good revenues, and proven model of success in the cryptocurrency world. So if we consider this as a enemy for the bull phase cycle one, so in to elaborate more, it's like in bull phase cycle one, people are going to pump up the available tokens, available equities back to the Nasdaq or New York Stock Exchange. In bull phase cycle, people are going to pump up a competitive or a equities that or companies that have a good revenue model that is going to be predictive and is going to grow a lot. And for the bull phase three, we actually bet on the dreams that companies are going to have a great enterprise value to sales ratio instead of their real profit generating business. So on the next one, we're going to look at charts of the gems. Arif, and so why Arif is valuable, survive. Also, good lending and borrowing probable. So on the right chart, we have Curve. So a Curve is actually a great, like stablecoin focus, lending and borrowing swap protocol. So it's also trend upwards. Like Arif, you can see, the price of 101. It actually pump like twice, for the whole bull run. So on the next one, right, we have the audience, optimistic roll up, and it looks great. So why audience is great is it, of course, is it going to generate good model? I'm not sure, but I know that it's a new token. It haven't been pumped, so a lot of liquidity or a lot of capital is going to deploy to increase the in time market capitalization of the OP tokens. So that's the key phase or the key takeaway for the audience, that we have to know that if some tokens are pumped up, that ranges are actually taking profits from these pumps. So when they are dumped, they will dump that, and they have the exit liquidity or exceeded their positions, and that really matters, right? So back to the looks rare, and why looks rare is really important in this bull phase cycle. This is because right now, we have a lot of good NFT marketplace like OpenSea, like Magic Eden, like Looks Rare, like X2Y2. So why do we think that Looks Rare is going to go good? Is because it has a good governance token, and the governance token is the holy grail of the luxury, abroad. So what do you think about that, Johnny?
Yeah, I think I want to talk about I want to respond to you that the CPI data that we definitely saw the prices falling, especially we could see that oil, steel, WTI crude oil, copper, soybean, corn, this kind of commodities were actually falling. The Fed actually I suppose the Fed actually doesn't want to have a hard landing. They want to have a soft landing so they don't destroy the economy, right? And right now, maybe it's that some people think that it might be a good buying opportunity, and maybe the Fed will successfully achieve a soft landing instead of a hard landing, so they don't crash the economy. And some also as for the whatever protocols, yeah, we have to be aware that what protocols survived from the last bear market, and these are things that we want to stay focused on. For example, Uniswap, DYDX, PancakeSwap, these are decentralized exchanges which which have real value, and they provide some very good services for people to swap their tokens. And it's different than centralized exchanges, because actually centralized exchanges actually they have the custody of your asset, right? If you deposit asset into centralized exchange, you actually let them hold your asset. But if you use decentralized exchanges like PancakeSwap and DYDX Uniswap, you actually hold your own asset. So there's a risk. So there's a risk if you let your asset to be held by someone else, and if unfortunately some exchanges has some liquidity crisis, like what we saw Celsius, and also other protocols associated with Celsius, they actually had liquidity crisis from bad asset management and also risk management, and they actually incurred a lot of loss, economic loss, financial loss to their users, and that's not good, and that's a risk that we have to consider. That's why in the current in the current bullish development, I would say a little bit bullish development, we are seeing a lot of pump occurring among these protocols. These especially particularly decentralized exchanges, right? Because they really have value, and they provide real services which are very useful. Actually, they are transforming the crypto market. The DeFi industry is actually evolving, and these are some good picks that we have to be educated. And yeah, Aave offered very good lending services, while Curve offers some very good stablecoin swap pairs. And yeah, OP associated with Ethereum is gonna facilitate development of projects in the Ethereum ecosystem. And Luxware is actually a very good one, I think, because it's a competitor to OpenSea, and it actually has its own government token, and investors are going to benefit from the protocol. And yeah, so yeah, the takeaway here is I can't wait to get back to the chart and see what's going on. Oh, we're seeing a little bit of supply here, and but we could see the supply comes with increasing volume, and let's see if demand will step in at lower prices around 21K. Hopefully demand will step in, and we're going to push forward, push upward, and if we break trend line, we'll welcome another bull cycle. So let's stay tuned to the chart. And yeah, SPX and also US 500, these are things. And if you want to learn more about the Wyckoff accumulation effect as accumulation scheme and also distribution scheme, make sure you stay tuned to our Twitter, our Huobi research Twitter, and make sure you search on Twitter Huobi research, and yeah, give us a following, and make sure that you get stay tuned, and also watch our latest published articles, and we have we actually have, as for the stream index, we are actually going to publish this report regarding, some very helpful indicators, finding, locating potential bottom formation. We have the stream index, which we are going to explain in the article that we are going to publish maybe 1 or 2 days later. And then we also have the stream index combined with the CVDD, the indicator developed by Willy Woo, which indicates the base price for Bitcoin, and also we have realized price, and also the SSR stablecoin supply ratio, which really provides some very useful insights into the current stablecoin supply market cap. And if you think about, if we have a lot of stablecoin available in the market, then we probably have more purchasing power to purchase Bitcoin, right? So make sure you stay tuned to the Huobi Research Twitter, and give us a like and smash the like button, and stay tuned to it. And lastly, we have a candy drop event in the last session. So make sure you are trading with, in the last 3 days you have 100 USD spot trading volume, and it's very easy to do that. And after, if you have 100 USD trading volume, then you can participate in the candy drop event. How do you participate? Once you have met the requirements, and then you can enter the new net listing area, and then you can select the candy drop, which round you want to participate, and then you make sure you register. You click the register button, and then you check your daily average spot trading volume. If it's 100 USD, if you have 100 USD trading volume, then you can register for it. The candy drop tokens will be, randomly allocated to the registered participants to make sure register for it. And then winner will receive the tokens for free. The token prices will be delivered to winner's spot account. And let me tell you a winning tier. The winning rate is actually calculated based on trading frequency and asset balance. So the more trading you do, and the greater asset you have, the more asset you have, the higher winning rate you have. So make sure you trade more on Huobi app, and also you deposit more asset in your Huobi exchange, and that's how you can increase the chance of winning the candy drop event. And additionally, the candy drop launched Lucky Star activity, and there will be one participant selected from each candy drop round as our candy drop Lucky Star, who can enjoy special airdrops worth of 1,000 USDT. The candy drop Lucky Star will be noticed via SMS notification and push inbox, and pop up some Huobi app. So the lucky winner need to email Huobi customer service if you receive the SMS and also the notification about how how you can receive the rewards. And the lucky star will also be invited to the Huobi candy drop activities. So it's really interesting. The candy drop prepared the double chance coupon for users who do not win rewards, and the no award winners will receive a coupon, and it can help them win double rate, and odds in this round will increase up to 100% using it. So make sure you stay tuned to the candy drop event, and hopefully we'll see you next week, and we will have more interesting and more exciting topics for you guys. So stay tuned, and make sure you follow us on Twitter, and stay tuned. I'll see you next week. Thank you guys for listening. Peace.